Well, happy lunchtime, everyone, and welcome to What's the Point, where we dive into topics at the Wyoming Business Council. And nothing is really off limits. We do have a couple ground rules, though, in terms of keeping things civil and respecting the mic. We are happy to talk a little bit about our loan programs today, and we've got Bert and Madison on from our team to talk a little bit about the loan programs that we have and also about the problems that they solve. Before we go into maybe all of those programs, Bert, I'm going to ask maybe I'll ask a few questions to prime the audience. If I'm stealing things from the audience, I'm probably not. Okay, so here's my first question. Why in the heck does the state need to get involved in loans? Isn't that why we have banks?
Well, that's a wonderful starter question, Josh. And I was just talking with others about this earlier, and I think there's a couple really good reasons why the Business Council needs to be involved in loans. The first one is banks have lending policies, and they can only lend according to those lending policies. One of our specific loans, and maybe one of our more useful loans, is the succession loan. That allows businesses that have been operating in Wyoming for 7 years or more to sell that business to maybe the manager, to maybe someone else. Um, what happens when you sell a business is there's a lot of things that can't be collateralized. Client lists, different pieces of things that bank won't consider hard collateral that they can't loan according to those loan policies on. So statutorily, when succession loan was created, the state, the business council, has the ability to loan on blue sky for those types of loans, for those succession loans, to keep Wyoming businesses running, to keep Wyoming employees employed. We can loan on the blue sky. So that one is specifically one of those gaps that without our loan programs couldn't be filled. Another one is some of our smaller community banks have lending limits. And so there are times based on the size of the bank, the capital they have, those banks might run into lending limits. And so for our 50/50 loan, which is our other more popular of the loans we have, we can help in those cases where maybe the bank hits a lending limit, excuse me, and we can come in on half of that project. Most of the time, and I would say all the loans that I've seen so far are loans that wouldn't happen if it was only for the bank. These are loans where either we need to come in to make the loan to value work from having a little bit of a lower interest rate. They're loans that I think with the state involved can happen, can keep things growing, can keep businesses running, but without those loans don't get done. So that's the role we play.
All right, so Bert was just talking a little bit about why the state or the business council in particular, who really is utilizing these state funds, um, it gets involved in lending at all to private businesses, and there are some gaps that occur. Really quick, while I see that a few folks have joined in, and while they're formulating questions, really quick, Bert. Can you sort of summarize the problem since we sort of think about this, there's a problem that exists and therefore we have a solution that can help that. Can you summarize that problem, do you think, in a couple sentences?
I can try and Madison or you can jump in here too and add to it. But really I think the problem that we solve is to the earlier point, a gap exists where banks can't loan because of their lending policy to sort of fill those gaps. Um, and so that's why the state, the business council, come in participation on these loans with banks to close that gap and keep businesses running, keep employees employed, and keep companies able to grow.
Madison, anything you want to add there?
I was just going to emphasize the partnership piece of it, where we're working in partnership with banks. And for those of you who aren't familiar, it's banks that are applying on behalf of the or as the lender, and so they're working kind of as a middleman. And maybe Bert can explain more and about how that sort of partnership works. But yeah, just emphasizing the partnership piece.
And I can definitely jump in. They're participation loans, so we participate with a bank. The bank leads. They lend according to their policies. We come in and support. Um, to Madison's point, the bank applies to the business council for these loans. The way that it works is really easy on a business. So the business talks to their bank. The bank applies to the business council. We give the money at the end of the day when it's approved, excuse me, to the bank. The bank distributes the full amount of the loan to the business, and the business only makes payments to the bank. Then the bank gives us our share as we're so from a business perspective, they're only dealing with the bank as the entity.
Nice. Nice. Okay, great. Thank you both for kind of that a little bit of an overview, bunch of different loan programs that we can dive into here in a second. But I do want to open it up to the audience. I see a few folks that might want to ask a question, and we'd be happy to take it. Well, seeing no questions and not wanting to wait out maybe 30 minutes of that, let's jump into your. I think Bert, you've got a presentation to walk through some of this stuff. Is that right?
I think Chris had something, he might be able to pull it up as we talk about banks applying. We have a quick presentation on what it takes for a bank to apply.
Okay.
Um, I can also talk through the other loans that are on the books and talk about the useful ones. But here's the quick slideshow that Chris helped us put together on what a bank needs to do to apply for these
Yeah.
loans. Like I said, from a business perspective, they work with the bank. The bank, that's where we have most of our relationships, come to the business council. We work through the details with the bank to get these approved. So if you go to our financing drop down under business and under loans, you can see all the different loans that we have available. I usually say 11 flavors of loans. That includes some bonding, that includes things that we typically don't do, but we do have roughly 11 flavors of debt options, mostly for banks. We do have BRC loans as well for communities. We have other types of loans. It's called the Partnership Challenge Loan under the Challenge Loan umbrella for communities. Um, but we've got about 11 flavors. I will focus that only the first two in that list in the screen, 50/50 and Succession, are currently being used.
And Bert, really quick on that too, before we jump away from that, maybe I do want to say if you're a banker out there and you're checking this out, again, going back to that problem where there might be regulatory reasons that you can't take on the full amount of the loan, or there are lending limits that you are bumping up against, or there are situations that occur. If this becomes something that say, let's say the Wyoming Banking Association runs into this all the time where they're like, gosh, all of our members are saying this is a real problem. What I want everyone to remember is that these can be fluid and flexible. And actually, if you don't mind jumping up one slide, Chris, back to the step one, I want to make a note of this because the natural gas loan was at a time when natural gas vehicles were going to be all the rage, and we were trying to sort of create these filling stations around the state, and so we knew that there was going to be a challenge there, and so we the legislature leaned in and said we're going to create this program with you, and so I want people to realize these are not set in stone. They can be flexible. We can create new ones if there's a problem that occurs. And us working together with the legislature to create that is the model that we want to do to when we find a gap or we find a problem in the business community out there. So just reminding everybody that it's not like, oh shucks, there's nothing, no options for us ever. It's more like, hey, maybe we could come up with something that fits a problem. All right, Bert, back to you.
All right, well, then we'll jump into step two. So after reviewing the details, then you can click, you can see on the web page, you get to 50/50, you get into there, you can see the statutes that enable this. You can go look at who is eligible. You can look at the loan details for this one. For 50/50, you can see we can do 50% of a project, which is different than 50% of a loan, to be clear. So sometimes we are 50% of the loan going to that business, and sometimes we're 50% of the project, which is more than 50% of the loan, and up to $2.5 million. The term is also important there. 10 years is the maximum term for these. 15% down payment from the business for a 50/50. And our interest rate floor statutorily is 4%, but we usually lend based on the bank's risk ratings. So most of those ratings are coming in where we're at 5.25, 5.5 right now. But as those risk ratings change and as interest rates change, then our interest rate will also change. But again, to that floor of 4%. So after they click that apply now button, we've now got a digital application. Prior to this, it was a PDF application. This is a big change for us. So this is what's called the pre-application. This is just making sure that we've got the information on the bank correct. We've got all the information that they want in that system correct. And then once we have that pre-application and you select challenge loan, we're going to review that, make sure everything is good. And then what we'll do is kick off the full application, which largely is attaching their memo, their investment memo, their policies, the things like that, so that we know that what we're getting into is according to their policies as well, and then how we want to understand that risk rating so that we can base our interest rate on that. And I think that's sort of the end of that quick application, but I think the important thing to note is we were going from PDF. We just got this stood up and maybe a few weeks ago for these new digital applications, so I thought this was a nice time to highlight that.
Right on. Okay. All right. Now that we kind of ran through that, anybody out there have any questions?
Yeah, I've got one for you, Josh.
Oh, we've got a question right on, Chris. Allred, thanks for joining in, Chris.
Yeah, of course. Riverstone Bank here in Cheyenne and office in Laramie as well. Thanks for holding this. This is helpful. So just kind of I think about some of our community partners that we have, SBA, Smart Capital, those kind of things. We're lucky in Wyoming to have those, plus Business Council, some stuff we've used in the past to help some of our customers. A lot of times when we've got a project that's like this, that we need some, I don't know, some support, that it's a viable thing that, again, bank can't handle it on their own or won't for whatever reason. How do we, outside of a formal application, how do we pre-flight these? Who do we have a conversation with that says, hey, this sounds like it's, viable, it might land in this program? Because we really love to do that with all of our community partners to help, augment our loans and help us to drive the business development.
Chris, that's a great question. I'm going to start with, we've recently lost our loan portfolio manager, John Wendling, who I know you were working with on a lot of different things. So if anybody out there has, people that might be interested in jumping into this role, send them our way as well. But until we get that hired, Chris, you can talk to myself or Madison, and we can sort of run through each of these loans and give you some sort of pre-flight information, like, yeah, that sounds like it's going to work, or it fits within all of our requirements. I know John was working with a few different lenders on making sure that maybe if it was a construction loan and the bank was going to float it, we can say, yeah, we think that'll work for the final loan, and be able to have some of those early stage conversations to make sure that it fits.
Great. Thank you.
And thanks, Chris, for joining in and asking questions and being part of this. All right, so maybe I'm going to flip it back, Chris. This is the challenge with asking a question, is you might get us to ask a question back. So you mentioned a number of partners that we have and that we're pretty fortunate here in the state. What other challenges are your customers seeing out there? And they don't have to be necessarily around the banking, or we're going to come up with a program for it. But we're just always trying to get a feel for the business community and the things that that might be slowing them down, or gaps that are too large to jump across. What are you seeing out there?
It's a great question. You've heard it a million times, and what I hear from a lot of my customers is workforce is a real challenge, huge
Yeah.
challenge, especially when they're trying to expand, to get people to fill those roles and grow those.
Yeah.
Which is first, Carter Horse, housing is the other part of the workforce equation.
Yeah.
That's a real struggle. Luckily, we're working with a lot of commercial developers to do some multi housing things. I think a lot of our bankers are. And that's, I think, going to be helpful. Is it the solution? I don't know, but it's a step in the right direction. But beyond that, there's always that. I mean, it seems like our well matured businesses have an easy time, getting financing. We talk about them. If there's any other lenders on here, I think they talk about it as well, that, this person could go anywhere and, kind of, it's the type of customer they're looking for. It's always that step from either, inception of an idea. We got a good idea. It appears viable to get it on the ground, to where there's nothing that, even regulatory wise, the banks really just can't lend on. We'd be scrutinized heavily if we jumped into something without, without having 2 years of history and, some of those basic underwriting things. So there's always that nebulous area where we feel like, a business might be viable, a service might be viable. But it's just that matter of being able to get the capital they need to kind of prove it, which is outside of our risk structure. But again, some of those community partners help with that. So I do have a little curiosity. I saw a button on the contract to apply for contract stuff. On its face, it doesn't have a value to a bank, but it's got an absolute value to whoever's trying to fulfill that contract, and may, be a lendable scenario outside of traditional banking or with outside support. So anyway, those are some of the things that are just, I mean, broadly, obviously, but then narrow it down to a banking lending standpoint.
Chris, I don't, this is fun. If it's okay with you, let's keep talking. So
I'm happy to
you're doing a
talk. I
great
don't know
job,
if
by the way.
it's
Like, is this are you moonlighting as a banker and you're just normally a podcast guest, or what's because you're doing great. Um,
Oh, thanks. I'm an idiot that talks too much, maybe. That's probably it.
Hey, welcome to the club. It's a fun place to be. You and I are in there for sure. So let's dive into this housing challenge.
Mm-hmm.
Talk to me a little bit about, from the bank's point of view, what are some of the challenges that developers run into? Because this housing issue is not going to go away. I think we're
No.
all trying to figure out some of the solutions to it. In a couple weeks, we actually have a number of projects that are coming at us, that are housing related. We always say that they're really a barrier to growth. They're not necessarily a housing project. It's a barrier to growth.
Mm-hmm.
So talk to me from your perspective. What are some of the stumbling blocks around housing?
I mean, the biggest thing, especially when you're getting into multifamily, it's an investment for an individual or a company or something to put a lot of money into multifamily, and then they got to figure out if it's going to pencil. And it's the number one hurdle is if rents are going to drive it and make it worth the risk to take up front, because there's obviously quite a long period before they even recover their initial investment, and then start making a profit on it. We're capitalists. Our customer are capitalists. We want to see them do well. It drives
Mhm.
the economy of the state and of our cities. So we want everyone to do well. And so I think there are usually the more players in, the better opportunity there is to drive something like housing, for example. But I think there's some really high costs to entry. Land is expensive. Infrastructure is incredibly expensive. It's pretty daunting and challenging to get through, especially if you're, well, in Cheyenne, for example, some of the requirements and code that the city has. I've seen it kill some deals just because it's been cost prohibitive on that front. So the biggest thing is obviously the cost, and then of course, the ROI for those projects that they have. And man, every community is so different that it's so hard to know. But again, I don't know that the costs are dramatically different from one community to the next, big or small in Wyoming, just because of the nature of the state being so spread out and small. But that's the biggest thing that I've seen is just the absolute, cost to get in, and it's a risk, and it's going to take some time to recover that.
Cool. No, that's super helpful. Not uncommon, comments around that. Those
Yep.
costs are tough, regulations are tough, the risk that developers face and that ROI. I mean, it's a complex problem, and we gotta kind of like look at it a bunch of different ways to solve it. And some of those solutions are going to create new problems. That's the way that works. And
Always
so
do. Yep.
I think leaning in with some developers and hopefully being able to kind of get a couple of these broken free will maybe show a path for other folks that are looking at it. So I'm glad to know that what we're hearing is pretty consistent. But I think it's showing the need for sure.
And I have seen some, I guess, I'll call it progress, with moving into what's worked in other places. TIF, tax incremental financing, has been
Mhm.
very beneficial to some of these bigger projects, and those kind of things. Of course, that's probably city specific. I don't know if there's opportunities to consider those kind of things statewide, but they do move the needle quite a lot toward that ROI factor and making a project viable.
Good. You led right into it. I was just about to ask, well, what kinds of things are working?
Hmm.
And what have you seen that are successful? So that's helpful. All right, one last question for Chris, and then we'll let him off the hook unless he wants to keep going. Um,
Somebody else can build some. I'm happy
that's
to
right.
yield
You're
the
doing
floor.
great. You're doing great. That's why I keep throwing them at you. So one other thing I was wondering is kind of taking more of a like a national or regional perspective, because as a bank, obviously you're focused on your community, you're focused on where you are in the state. But as you go to conferences or talk to colleagues, or if you have branches outside of Wyoming,
Mhm.
what kinds of things are they doing that might work?
As far as to help drive the housing issue, we're
Yep.
still
Yep.
talking about that. Um, yeah, I what I've seen in some of because our bank is southeastern Wyoming, then we go all the way across Nebraska into Omaha, um, kind of an I-80 corridor thing, and we see a lot more like TIF, for
Mhm.
example, in those metropolitan areas in Nebraska, Lincoln, and Omaha, where they're able to put together some really, kind of cool big projects. Granted, they're bigger metro areas, um, but again, just the opportunities there makes those a little more viable. They, frankly, though, on a lot of other commercial fronts, as far as community support and things like that, our Nebraska banks are extremely jealous of the tools we have available in Wyoming, and the Business Council being one of them, of course, that they just do not have set up, or nor do I think there's any appetite or movement toward that.
Yep.
But I mean, that's the biggest thing is those upfront, and we do it, commercially, obviously, incentives to bring industry to the state and things like that, which I think makes incredible sense. But some of those upfront incentives are really what's kind of moving the needle on those, giving
Cool.
a little bit of a safety net for those big risks.
Yeah, you bet. You bet. Good. Well, thanks a ton, Chris, for being willing to jump into the fray and work with us on not just the loan part, but also on the podcast part. This is good to do.
Yeah, you bet.
Um,
Happy to help.
yeah. So okay, Bert and Madison, the spotlight's gonna be back on you two for a while. So talk to me about what happens when a loan goes well. Like what happens? So people are able to either take over a business or start their venture, and then so how does the state benefit in both numbers and in like maybe the goals of this agency?
Sure. That's a really great question. I think the answer is a lot of things, right? So it's not just one thing, but I'm thinking about we'll start with succession. So if a succession loan goes well, again, we're taking the blue sky, so we're taking a little bit of a different risk profile than the bank lending on a fully collateralized loan. But if it goes well, that business or businesses stay running in the state. they keep employing the people that were already employed, and hopefully they then start to grow, right? So succession is more of a retention function in its early stages, but once it goes well, you know, that business now has the ability to maybe take a bank loan without the business council involved for growth. And now they can add employees. They can change their geographic space. Maybe they can expand into another community, into another state, and they can do more because they have that foundation of getting that transition to happen, and then they can grow. Uh, when I think about a 50-50 loan, if it goes well, most of those are already for the purpose of growth, right? They're looking to buy new equipment or build a new building, or so most of those are going to be likely lines of credit in some cases and other things, but they're growing employees and they're growing their market share and their maybe even their regions as they're growing these things. So for the state, that is additional employees being employed. That's tax revenue, that's sales tax. If they're building these buildings, that's property tax. There's a whole bunch of benefits to 50-50. Chris mentioned contract loan, not great for a bank because it does require 2 letters of denial from banks for us to be able to jump in. Because our goal is to not compete with the bank. We're in a bank. We're trying to participate on the ones where we're changing the risk profile. And for contract, that one's specific for those early stage businesses that Chris was talking about, where it's like maybe they don't have 2 years of financials. Maybe they can't get these bank loans yet, but we can come in and we can provide a small loan for materials to fulfill contracts. So that gets them up and running. So the next one, maybe they can use a bank loan for. And so again, if that one is successful, that gets these early stage businesses really the ability to grow quickly, to get contracts done, to maybe do more than they would otherwise be able to do if they were just bootstrapping.
Cool.
Madison?
Madison, anything to add there?
Yeah, just wanting to add too that I think from a community perspective, the succession loan, the 50-50 loan, preserving businesses, talking about expansion, it's also in a way increasing capacity for those communities. I know one of our successful 50-50 loans had to do with childcare. And so, I mean, that hits workforce and business and, all those sort of things that are required for communities to thrive and be successful. So there's another layer to that that goes beyond the loans.
Yeah. Yeah. So there's like, I kind of think about this like maybe a quilt or the fabric of the community. You've kind of got these different pieces that when they work together, it makes the community what it is. And, Bert, you talked about this a little bit too. And Madison, you touched on this idea that in a lot of cases, we do have some pretty small businesses around the state that are a major, they're an employer in the community. They're kind of a stalwart of the community, like they're there, and once they leave, nobody might come back in and run a business again. And so I think that succession and keeping a business in town can keep our really small communities vibrant. I want to touch on something, Bert. Oh wait, you looks like you were ready to add some stuff to that.
Yeah, I just want to add one thing, and I think this is maybe I overlook it because I think the impacts of these loans are really to help businesses grow, help businesses keep running. But realistically, when they're successful, the money then comes back to the business council and we can loan to the next business, right? So this is a revolving loan fund. So all the success builds more successes that we can do more loans to more businesses and really keep it growing.
Yeah. Yeah, I think that's really key. So I want to touch on 2 things that you mentioned before, and that is sort of like this idea that, well, you've said risk profile a few times. You just talked about like letters of denial, and yet here's the state coming in and loaning money to people who are getting denied by banks. And so, talk a little bit about that.
And I think the beginning and sort of like the way that was created is, again, the Business Council, we are not a bank. We do not want to compete with banks. We only want to be helpful. However, there's a gap that exists for some of these companies when we're talking about a contract loan, they can't get a loan. And so, in order for us to not compete, we need to say, okay, you went to a couple banks, they've said no, you can't get this loan. Now, how can we help the business that can't get that loan? We aren't taking on a significantly different risk profile. We've changed the way the agreement works for those loans so that we're a co-payee on the contract, right? So they already have a contract to produce all of these widgets. We fund the raw materials. So the raw materials become our collateral and we're a co-payee on the contract. So the risk profile isn't totally different. We've just shaped it in a way that works so that we can help those businesses that otherwise couldn't get debt financing from a bank because of their lending policies. Um, Again, when we talk about a 50-50 loan, those are loans where the state is fully collateralized, just like the bank is. So we're essentially taking on the same risk profile as the bank in those loans. And then succession, again, is a slightly different risk profile because we're lending on blue sky. And so we aren't always fully collateralized. Sometimes we are, and sometimes we have some collateral, but we're taking on a different risk that the bank can't take to get these businesses so they can transition to new owners.
All right. So now, if it's unless we've got a question, anybody have a question, raise your hand. And don't worry, if you ask a question, I won't necessarily throw you like four other questions right back. Oh, I should have done that at the end with Chris because now people are like, I'm not asking a question. I'm going to have to end up being a podcast guest. Um, okay. All right. So let's keep rolling here. I have a question for you about um, kind of about we'll call it the entrepreneurial continuum. Okay. I have this crazy idea. I want to start a business and I'm working through some of the other programs that the local level might have, the university or community college system might have, and maybe I won a contest, maybe I did a Kickstart, and I've kind of figured out my product market fit and I'm ready to go. But then there's this big gap of funding until YVC, right? So you're not going to approach venture capital for a while. And we don't necessarily have any mechanisms in there right now, except the loans. And is that a tool that has been used much by the entrepreneurs?
It's a good question. I would say those paths are usually distinct.
Okay.
And I'm going to say
Hmm.
usually. So if you're a product-based business and maybe debt's your thing, you sort of need to get those 2 years of financials and you need to work with a bank and maybe a line of credit. And however, if you think you're going to be a high growth company, debt is likely the wrong funding mechanism because venture capital doesn't want to see debt on your financials because their investment then pays debt and not pays for scaling and growth. So so typically when you are that business and you've got product market fit, you need to make that determination on how you want to grow. Um, they're usually unique. The only place where I see venture and debt overlap is what's called venture debt. And you've just raised a round of funding, and now you raise a debt facility that maybe you never draw on, but it gives you a little bit of security if things go sideways. And then you have a line of credit sort of debt that you can draw on, knowing that the term is very fixed and all of it is due on one day, no matter what you draw. If you draw the whole thing or if you draw. So that's sort of the only time I see an overlap between the high growth path and the debt path. So they're usually different.
Okay. So, so with that in mind, thinking about some of our partners, for example, right? So you've got the Small Business Development Center, maybe Manufacturing Works. How how often do their clients utilize our loan programs? Is there good overlap there, or is that something we need to kind of like fill that gap?
I would say, and Madison, jump in here if you've got additional insights. I would say sometimes, but not frequently. And I think some of those partners are Wyoming Women's Business Center, so they have micro loans
Yep.
that they can maybe do to get things started. This Wyoming Smart Capital that Chris was mentioning, the SBA. We've got MoFi, the CDFI, Wind River Development Fund, Wyoming Capital Access. So we have some of these things, but what I think is happening most of the time is once they get one of these layers of assistance, they can get across that 2 year finish line. They can then have financials, they can be bankable, and they can maybe move without other layers of assistance. Um, so we've had a couple where SBA and ours and the bank all come together. Um, we've had a few where I think it maybe was a Wyoming Women's Business Center microloan, and then maybe we had something later. But I don't see the overlap as much as you might think.
Okay, so there are, I guess the point is that there are other partners, depending on what your needs are, that might fit you better, or if we need to work together, great. But in a lot of cases, kind of spanning that 2 year gap is really that big challenge if you're, especially if you're not necessarily some high growth startup that doesn't want to take on debt because you don't want to mess with your balance sheet while you're growing and you're trying to sort of like think about equity plays, not debt plays. So that makes some sense. That I think that helps. At least it helps me, and I bet it will help people who watch this kind of understand. Hey, there are these different channels that people are going down depending on their business, and they've got to have different tools. So there's probably less overlap than we think, and maybe even more gaps. But as we figure this out, we'll see what those are. Is that correct?
I think that's exactly right.
Okay. All right, so I'm going to open it back up to the audience to see if there are any other questions or comments or thoughts that folks have. And then I'm going to turn it back over to Bert and Madison for final thoughts or questions that I didn't ask and to give me answers on those about loans. All right, I don't see any questions from the audience. So Bert and Madison, final thoughts.
I mean, I think the tools that we have in loans that can support our local and lending institutions, banks, credit unions, to Chris's earlier point, are useful. They help close some of the gaps. I think they're, to your point, Josh, there's still a few gaps out there and some work that we still need to do on really understanding if the state has a role in those gaps. Um, I think the ability for us to close those gaps to support business, to both have a role in retaining workforce, but also growing business through some of these loans, is what we as the state's economic development agency need to be focused on. Is how do we retain and create jobs for the people of Wyoming? So it fits really squarely within sort of our role as the business council. Um, and and then Chris said it earlier, but I think a lot of states are a little bit jealous that we have these tools. And I think not only loans, but equity, but Kickstart, but SBIR, and have the tools that help fill some of the gaps to help Wyoming businesses be more successful than the national statistics would say.
Right, nice. Madison.
Yeah, just to add on, the 50/50 and succession loan that we talked about kind of just scratches the surface. And we have other loan programs that aren't currently being used but can. And then just to your point earlier, Josh, of like if a big bank has an idea of how we can work together better, I think we're all ears. So just encouraging that collaboration is something I would stress.
Yeah, yeah, great. Well, Bert, Madison, and Chris, thanks for your work today. I appreciate the heck out of all of the work that you're doing, and it's good to hear that Wyoming does a lot of things right that other states are jealous about. I think a lot of times we look at some of these big macro trends and we think, gosh, things are really tough in Wyoming. But when it comes right down to it, we do a lot of things right. And I think that we have some really good examples of programs that kind of close those gaps that Wyoming might feel because of our sparse population and maybe our, the fact that we just don't have that many people. But I think our business community can be strong with some of these programs. And again, it's good to hear from folks and listen to what is being said across the state and the challenges that we face. And we're all ears here. I hope that this was informative for folks that joined in and folks that watch later, and also an open invitation to come in and talk with us. We want to hear from people. We want you to ask hard questions. We want to be as transparent as possible and really get the information out there so that we can solve this really big problem that we have in the state, which is long-term economic decline and our youth leaving the state in numbers that are just frankly unacceptable to Wyomingites. We want to see them, thrive and live here and enjoy what we have all found is the beauty and wonder of Wyoming. So thanks for everybody for joining in, and we will see you on the next one. Bye now.